Hi, welcome to this video, which is all about Forex money management. We're going to be looking at stop loss orders, how to place them, some common mistakes that traders make, and also one of the most effective stop loss orders of all, which very few traders actually use. Now, in terms of common mistakes in stop loss orders, the most common one of all is placing a stop too close, and you'll often see people recommending 10 or 30 pip stop loss orders on the net. It's complete nonsense. You'll never make any money doing that because you'll just be picked off by volatility. As a general rule, let's say you're a swing trader for turning points, you're probably looking at 50 to 100 pips. If you're a trend follower, probably 100 to 200 pips on entry. And they are realistic levels in terms of market volatility. And there's no point in having a stop close and thinking you're restricting risk, only to just take a huge amount of losses. Now, I've said before, day trading and scalping are a waste of time. No one makes money doing that consistently. Stick to swing trading and stick to trend following. Swing trading stop losses are generally pretty easy. You can get your stop in, quite tight, and you just want to be just one level back if you can from where the herd place their stops, which will normally be obvious on a chart. Trend following, it's the same. You need to give the market room to breathe. And obviously with a trend following system, you are going to have to be trailing that stop up, okay? Because you're after the long-term trend. In swing trading, you're probably just going to have a target and get out. Now, when trailing a stop, a major mistake that traders make is they put it to break even as quickly as possible. That's complete nonsense. You don't put a stop loss order to break even just for the sake of it, because you might actually be stopped out and the trend goes back your way. You put your stop where the level is logical, or behind the level that's logical, where you consider you're wrong. That doesn't necessarily mean break even. So never do that. If you're trend following, you're after trades that are going to be lasting for weeks on end. You need to follow up your stop loss slowly. And I would normally say a good place is normally somewhere behind the 40-day moving average, a support or a resistance level near that. You're going to give back profit obviously at the end of the trend. No one knows where the end of the trend is going to be. And that's fine, because so long as you get a good chunk of the trend, you're happy. Now, with stop losses, one thing I noticed as a broker is what I call stop loss clusters. And what you want to do is when you're placing a stop, let's say there's a level you're trading into. It could be 130, let's say, in the euro. And prices are coming up to that level and you want to sell a downturn. Where do you place your stop? Well, you don't place it 10 pips behind that level, okay? You need to be one step back from where the herd are going to put their stop losses. The herd will always tend to put it behind the first level. They'll very often get picked off, then the trend goes back the other way. If you're a trend follower, you just have to have your stop that little bit further back. The most effective stop loss order of all, I think, is a time stop loss. And I read about this when I was reading about one of the great traders, Paul Tudor Jones. And what he would do is he would place a trade, and if the trade didn't go his way in a day, then basically he'd be out in the market. So regardless of whether he was in profit, if he hadn't reached his objective within the day, he would be out. Now, this is highly effective when you use a time stop loss on breakouts. If you're expecting a breakout to move quickly, it'll normally do so on the day. So you'll normally finish up near the highs. If you don't finish up near the highs, then it could be a fake out. Let's face it, there's more fake outs than breakouts. So, okay, so you're still in profit, but it's settling near, the middle of the range or whatever, you just come out. I mean, it's a fantastic tool. If you try it on breakouts in particular, it's highly, highly effective. And on any trade, really, because normally if you're expecting a trade to move, it's going to move fairly quickly. So if it doesn't, get out. You don't want to be caught on the rebound. You don't have your money tied up in markets that are not moving. Now, in terms of stop losses, they kind of, traders do them as an afterthought. They just, they don't really think about where to put them. You need to look at the chart and, just think where other traders might have their stop losses, and then put yours slightly behind. You're still going to have good protection, but you can basically avoid that. And we've all had it where you get picked off on stop. Now, the guys who are naive traders are always right behind the level. Too close within the noise will get picked off. Just get yours that little bit further back. As a general rule, I think never use a mental stop loss. Always place it in the market when you place the trade, so you don't actually override your stop loss. If you run a mental stop loss, you'll override it. It's a common thing to do. So put your stop loss in straight away. From that point, you know what to expect if you lose. Things can only get better. So I hope you enjoyed this short video on Forex stop losses and money management, and I'll be back and I'll speak to you soon. Take care. Thank you.